So as I said, Texas is going through a bit of a VC renaissance these days. Some of us are old enough to remember Austin Ventures. But out of the wreckage of Austin, or the people who followed on to Austin, there's been fantastic growth and great entrepreneurialism in Texas. And I'm lucky that we have Becky Taylor speaking. We're going to have Joe McCall as well. Johnny Wynn. Johnny, are you there? I know he's online. Johnny, there you are.
Hey, everybody.
Johnny manages venture capital for a family office. Peter Bell, who kind of traveled with us and raised some capital in his group. I was talking to Peter on the phone the other day. He was telling me that they raised money, and right now his portfolio has several unicorns in it, so that's fantastic. And Patrick Flynn, I think. Patrick, are you there somewhere? So we're ready to go. Christine Grogan. Christine, hi, how are you?
Hey there, how are you?
Fantastic. And Christine's going to lead the discussion. If any of you guys have an opinion on fintech as well, feel free to offer it. But Christine, why don't you take over? Thanks.
Sure. And the only person I don't see yet is Patrick. I know he was, Patrick, you there?
I'm going to find him. Just why don't you guys start?
He did text me. I checked on him by text. Hi, everyone. I'm Christine. I live in San Antonio. I am not a Texan. It sounds like many of you are. I've lived in New York City, San Francisco, Orange County. I don't even know where other cities. About 10 cities I've been in. Miami was another one. But now I'm here in San Antonio. I moved here for a company that was private equity owned by Apex. They recently sold to 3M. And so I was the head of marketing for the Americas, and they gracefully walked me out with my Scotch tape and Post-it notes. So here I am today. Thanks for having me. I am not a private equity or venture capital person. I've been on the other side of it, being bought, purchased, sold. But I'm really excited to interview this panel. Rather than me trying to introduce all of them, I have spoken to them. They all have very different, diverse backgrounds. I think we'll just go right in order. We'll start with Becky. I know you're in the room, and then Joe is on the line. He's in the middle of moving. So Joe, thanks for being on. And they're with Fontech Ventures. Maybe a little bit about you both. And a question I'll have for everyone is, with COVID, how has that impacted your business?
I'm not sure this is on.
It's on.
It is? Okay. Hi, Christine. I've been looking forward to meeting you. I have to crane my neck to look around at y'all on the screen.
If you want to, you can just move over to that seat.
Okay.
Just carry the microphone with you.
And anyway, I'm a 35-year Austin resident and a startup gal. And Joe and I have known each other a really long time. And Joe invited me to get involved as a board member of Fontech Ventures. And so I'm going to defer to Joe because I view him as the initial investor in all this, and has enabled a whole lot of forward progress that I think the audience will find very interesting to hear about. But my own background is I'm a recovered computer scientist, a bit of an inventor, and starting 20 years ago, I started working with the venture capital side of the table, and so I've been on both sides as a founder getting funded and as a funder looking for founders. And so I'm just delighted that Marty reached out and asked us to get involved because I'm very, very excited about the model that Fontech Ventures is kind of creating from scratch. It's not your normal, typical venture fund. And I'll let Joe describe the structure. So I am delighted to serve as a director. We are onboarding our first 2 or 3 companies with deep tech AI. It's our total focus. Very early stage. We're looking for founders that are really going to go deep and broad in big markets and apply true AI technologies to these huge problems. And we look forward to helping them. So I'll turn it over to Joe.
Thank you so much, Becky.
Thank you, Becky, and thank you, Christine. Pleasure to meet you as well. And a shout out to Marty for enabling all this for the group. I'm a native Texan, been in Austin since 1980. Did 20 years as a financial advisor through the ups and downs, the crash in '87 and the internet bubble and boom and all like that. And stepped out about 2002 with a lot of experience of seeing markets up and down and sideways, but also was here on the ground as Austin discovered itself and created itself, if you will, sort of willed itself into existence as a technology city, and was involved in several of the efforts early on. to make that happen. Served simultaneously as program chair for the two largest and oldest tech networking groups in town, Technology Advisors Group and what is now the Austin Technology Council. Kind of learned through my years. I went after the people that were inventing the future and just asked them, tell me what you're doing. And so I learned what the future would look like by listening to the people that were creating it. And I always found it enormously stimulating. So when long story short, was involved in an operation here called the International Accelerator that focuses on foreign-born entrepreneurs. Met a gentleman who introduced me to a friend of his, Nick Kyrinos, who is a global scale AI guru, and had the opportunity to assist him through a little rough patch, and subsequently he asked me to join the effort to create FoundTech Ventures. As Becky stated, we are a bit different than the usual one. I'll get into that. But that's how I got here, and that's where we're going.
Joe or Becky, just before we go to the next group, anything you want to comment on COVID, since it's on everybody's mind? How's it impacting, or maybe it's not impacting?
Well, the only impact on us was I had the whole team. Nick was in from Cyprus. Salvatore Minetti was in from London to present at South by EU, and had the whole team gathered, and then they canceled on us. So we were stuck in a very nice Airbnb, had a week to kill, and we just dug down and did a lot of corporate stuff, and ginned up some other meetings from people that weren't available when South by was on, but were available when South by got canceled, and actually had a very productive week and great team building for the first time. So that was our only impact.
So not so bad.
Lemonade out of a whole bunch of lemons. So the biggest impact on me, Christine, is that I have a whole new wardrobe of these things. I never have ever thought I would be
my wardrobe, just for the women in the room, is a blazer, and then I have shorts on my bottoms, and that's what I thought an investor could actually start selling Brooks Brother jackets and Puma shorts and make a lot of money. So that's it's been fun, but we'll have to have a little bit of humor today. Thank you. Johnny, you're up next. Johnny, you're in New York City, right?
Yeah, New York. It's very hot right now. So I'm Johnny, originally from California, and then moved to New York recently. I run the venture arm of a family office that also does public equities as well. My background is interesting. I studied entrepreneurship at Stanford, got very lucky out of grad school, started and sold a couple different companies, and then transitioned to becoming a recording artist. Started the band Cathedrals, did the whole tour thing. And while I was doing music by day, by night, I was consulting and advising a number of my friends' high-tech startups. One of my roommates started Asana, and another buddy started Patreon, and another buddy started Lever. And then one of my roommates started a family office, or rather started a fintech company called Sentio, which is a data platform used by investment managers, hedge fund managers as a way to gain insights in public markets. Sentio competes directly with Bloomberg on their terminals and also CapIQ. And he had started this platform as a way to gain alpha for his family in the public markets. So I was helping advise the family office while being a touring musician, helping source venture deals, helping incubate companies. We co-founded a company together called Thistle, which is a Freshly competitor that's grown to about 400 employees. And fast forward 7 years later, they asked me to join, to come on board full-time as a partner in the family office to help launch what we're calling Studio Management, which is the venture firm of the family office. We invest opportunistically across stages and sectors. We love collaborating with other family offices as well on different deals. We have headquarters both in San Francisco and New York. Our partners live across both regions, and so I cover all the New York startup scene. My partners cover the San Francisco startup scene, the Silicon Valley startup scene. And so in terms of how coronavirus has affected our business specifically, one of the things we like to think about is a great Bill Gurley quote, where he sees opportunities like this as a great time to actually double down on investing, because a lot of people who were in the business, who were starting companies during boom times, are doing it A, for the money, or B, because capital is cheap. And so what happens is you strip away a lot of folks who are starting companies for those reasons, and what you have left are companies that either have sustainable business models or really passionate, aligned founders. And that's something we're really looking for in our investment mandate. And so we're really doubling down. We just put together a $6.5 million SPV into a Series B company during COVID, like during peak COVID around March, April. We've been making a number of seed stage investments as well. On the public equity side, my business partner runs all the public equities hedge fund stuff. Because we're using Sentio as sort of a way to gain alpha in the public markets, we're also using that same data-driven approach in the private markets as well. We've seen a lot of opportunities in both public and private markets because of coronavirus. So thinking through the first, second, third order effect of how different industries, different trends will play out. One of the things that we're seeing just from our vantage point as both investors and entrepreneurs is coronavirus is forcing people into certain behaviors that they would not have done in the first place. So case in point, we are all on a Zoom call for a conference. I have this thesis around what I call perceived friction versus actual friction. For example, ordering groceries online. Most people perceive there to be a lot of friction in doing that. You have to download an app, you have to put in your credit card, when in reality, the actual friction is very low relative to having to get in your car out of your house into the grocery store. And so there's an activation energy cognitively that is now removed because people are forced into this new behavior. And so a lot of what we've been thinking about directionally is, where are those perceived frictions now being removed because people are forced into these new behaviors? And as investors, where do we want to place our bets in the next 3, 5, 7, 10 years in both the public markets and private markets? And so we had a big position in Zoom in January, February. Fortunately, with COVID, Zoom stock has done really well. We have a portfolio on the public side and a number of distributed work tools and things like that. On the private side, we've been looking into a number of companies that are similarly moving in that direction as well. And so we've been looking at this as an opportunity to really double down on our efforts.
So really, when you have your consumers online versus when they're in the store, you can't see the behavior. The predictive analytics are more mainstream because you have it all pretty much on the computer, watching your consumer rather than seeing how they act in a grocery store.
Yeah, exactly. So just as an example of that, I think we were looking at an Airbnb secondary opportunity. Through some alternative data sources, we're able to get credit card data in order to see on a macro level, non-personalized credit card data rather, in order for us to see on a macro level what those revenues might look like over time. And so with coronavirus coming, we could sort of see the decline in people buying Airbnbs, transacting with their credit card data, which helps inform our decisions on in the secondaries.
Yeah, no, I think we'll come back to that, Johnny. I bet some other people will have something to say about just the whole behavior online you're able to capture. I'm just going to go right in order, no specifics, just Peter, I think you're next. And Peter is out in California, San Francisco, where Johnny is co-living. So welcome, Peter.
Thank you, Christine. Great to be with you and my fellow panelists. And thank you, Marty, for organizing and inviting me. But yeah, my name is Peter Bell, and my firm is called Amity Ventures. We're based in San Francisco, right across from the Transamerica building. And many of you have probably visited that landmark. I am originally from Midwest, from Minnesota. I went to school at Boston College and then business school at Harvard. And I've been involved in really startups for, I guess 35 years. So essentially my entire, I guess, professional life. I was fortunate enough to join a startup right out of college that was bootstrapped. It was a very small company, and eventually was acquired by Dell. So in many of your neck of woods there in Austin, Round Rock, for $67 billion, a company called EMC. So I started there very early, I worked for the founders, which were the initials Egan and Marino. They were my first two bosses. And it's one of the largest companies ever built in the US with no venture capital. So really a great American success story. I then started a company in the cloud computing space. I was backed by two great venture firms, Greylock and Sigma, and we took that public, and then eventually sold that to EDS. And then I was on the faculty. I was teaching at MIT Sloan and Boston College, teaching entrepreneurship. And then I started investing initially my own capital, and then joined a larger firm, Highland Capital Partners. We had about $4 billion under management, and eventually the founders asked me to run the firm. I did that for about 11 years. Moved from Boston back to the West Coast where I'd been with EMC. And then about 3.5, 4 years ago, myself and the kind of team in Palo Alto, we spun out of Highland and formed Amity Ventures. And I met Marty in that process. All of our capital, we initially raised about 130 million, all comes from family offices. So we work with many great families, mostly in the US, a few in Europe and one in Asia. And it's been very exciting. There's a lot going on. I really enjoyed Johnny's comments on some of the things they're looking at and some of their thesis. We spent a lot of time around the digital transformation of the enterprise. That's kind of where I've been spending most of my career, which is, I guess we can talk more about that. But the COVID question, yeah, it's been our busiest 4 months in our short history, but in terms of both dollars invested and number of deals. And essentially, I think this COVID has really, probably accelerated 2 to 3 years behaviors, some that Johnny talked about, but I think it's also transformed or accelerated the transformation in the enterprise. So we have companies, I was mentioning, one of our fastest growing companies based in San Francisco is called TalkDesk, and they sell what's called contact center software. It's really a great story. Tiago moved to the US and started his company. We met him when it was 4 people in Mountain View, California. But this idea of a cloud-based call center. And with COVID, call centers have all gone remote, so the number of seats has accelerated. So their business is up 3x over the last couple of quarters, and just an amazing company. They just raised their last round. They just announced it last week. Was done at about a $3.4 billion valuation. So really an amazing growth story. So that's the kind of companies that we want to invest in. We typically invest early and then partner with the entrepreneur, on their journey to hopefully build something that's consequential and important to our world.
That's great, Peter. Congratulations on that. I think what's interesting about all 4 of you is the different approaches you're taking. I'm going to introduce Patrick now. Patrick Flynn. He's actually with 2 different firms, but as of late, Manhattan West, the other one's mentioned in the program. And Patrick's I think his approach is a little different. So Patrick, welcome. Are you there?
Yeah. Can everybody hear me?
Hi.
Yep.
Hey everybody. And Marty, thanks for having me, obviously, and it's great to be a part of such a wide variety of panelists, and you guys all seem like you are. And it's incredibly informative to listen to everybody here, at least so far. And so just as a little bit of background, I graduated from Dartmouth College, went straight to JP Morgan. So funny enough, I don't know who was talking about that earlier, but I was at JP Morgan for a couple years. And then I went to a mutual fund and then moved into private markets. I've been in the private markets for the last 6 years in private equity, but also in venture capital. My most recent stint, so I know we talked a lot about Zoom, right? So I'm an investment partner at TSVC. TSVC is an angel fund and an early stage venture capital fund. They're actually the first institutional money in Zoom. So in their pre-seed round, and it's super interesting to see how Eric and how that team has evolved over this entire time frame, and which leads me to my most recent venture, which is with Manhattan West, which is actually an alternative asset platform. It does private equity, it does real estate, it does venture capital. And I think what's interesting about them is and the reason why I really wanted to, I thought it was such a great opportunity is they want, what they really want to capture is investor realized returns. And so what I mean by that is we have a fundamental belief that it's great to have paper gains, and they're wonderful, and TVPI is a great way to look at returns, which is total value paid in. But what we want to do is actually capture returns for our LPs. And we think based on the current market environment, based on COVID, like we talked about, there's digital transformation is here. And I think earlier, Peter, you mentioned that it's an accelerated transformation of a lot of these companies, and I would agree with you. I'd also say it's an accelerated timeline. What we've seen is people and companies that are they've come out with their product, but maybe it wasn't the right product. We really feel like there has to be a good mix of things, market opportunity, the right product, the right clients, multiple things, the right opportunity, and then how teams make it work are all going to come together to make sure it's a right fit. So I guess what I'm trying to say is COVID hasn't really impacted our business in a sense, but what it has done is sped up the process of we're late stage investors, and we want to make sure that these companies are well capitalized businesses. So anyways, COVID has, as both Johnny and Peter have mentioned, has really sped up that timeline to be able to see whether these businesses are going to be successful or not. So anyways.
Thank you and welcome. One question I have for all of you, because I'm just trying to make it relatable. I come from healthcare, so I've worked Pfizer, Allergan, now AbbVie. I'm always worried about data breach, cybersecurity, because of HIPAA and all the patient things. How does that relate to your world? And each of you in your notes to me have talked about AI for the most part. So how does that all kind of work in your world?
We're going to go in the same order. I'll kick off there. I need to take a moment and explain who we are and what we do. I didn't know that we were going to run the commercial that quickly, but it was very informative to see what the other panelists where they lay. Pat mentioned they're late stage investors. We are the extreme other end of the spectrum. We are the earliest stage investor there is. Our founder, Nick Kyrinos, I said 30 years plus in AI, has a fundamental belief that for AI in particular, the traditional models or the Darwinian model of early stage investing in the marketplace is fundamentally broken. That the people that are going to really be advancing into uncharted territory in AI have to have such an extreme focus to be that person that by default, they don't have time to learn anything at all about business, starting a business, running a company, any of that. They are that nugget of brilliance. And when they go out on their own and try and start a company, the vast majority of them flounder around and head in the wrong direction or waste a lot of time doing wrong things. And only occasionally do they find the right partners and a good investor and the sort of the right coaching to realize the potential of what they held in the first place. Our aim is to kind of catch these folks almost like when they're walking off the stage with a diploma in one hand and a fantastic algorithm in the other. Let us help you. Let us help shape you. We will be co-founders. We will bring to the table all of the pieces that you need. So essentially, we're taking the best pieces of an incubator and an accelerator and early stage VC and putting them end to end in kind of a business factory or business studio, and mentoring them along the way, educating them if they have this potential to be their own CEO, teach them how to do it and make sure they're doing it right from day one.
I think you and Peter, in the little bit I know of you both, I think that's sort of Peter's model too, right, Peter?
Yeah, we're probably not coming in, as early as Joe is. We're usually coming in when there's some traction. But some of the areas that Joe was talking about, AI, we have a company called Eversort. It was 3 folks from Harvard Law School, but they were computer scientists, and they basically using AI to read legal documents. So they can take a document that would take a paralegal 3 or 4 hours and it reads it in 6 seconds with like 99.9% 99.9% accuracy. So we actually, back then when they haven't gotten the diploma, Joe, but that was a little earlier, but they had 10 customers. So we got to know them well. Their first year at law school, we ended up backing them while they were third years at law school. But so we like to come in, we say we kind of say, we don't want to start the fire. Something's already burning, and we want to put fuel on the fire, which is, capital and some of the mentorship things that Joe discussed.
Yeah, you spot on with that, and I'm sure that immediately the guidance that you were able to provide them helped them align and focus and sort of point in the right direction, and instead of whatever they thought was a good idea, because heck, they're trying to be lawyers, and we know how wrong that can go, right? So. But yeah, in this case, we are going to be pushing for deep tech AI. One of the other things that I have seen through my time is that it's about a generation after technology sort of originally is developed or invented, that it takes that long to sort of scale and come down in price and become widely available enough that it's applied in so many areas that now you also have at the same time a generation of people who've grown up knowing that this technology exists, and they are now in companies in a position to make decisions, say, yes, we are going to embrace whatever this technology wave is and take it to the next level. So AI, as we know it, is 30, 40 years from some sort of the crudest first definition to actually being used now, machine learning, natural language processing, things like that. But our feeling is that that's just the sort of opening wave, that there's a lot of new things to be developed. New tools are being created, and we're creating some of them that have not yet been done at all. And that's where some fantastic opportunities and sort of the hyperbolic acceleration of AI as an overall definition is going to take place. And it's going to do some astonishing things. So that's the kind of people we're looking for, and we want to catch them early so that we can do that shaping and advising like Peter does, and not sort of waste time and effort and burn up tons of capital. Because I'm sure all of you have seen this as well. There's a ton of stuff, once it becomes a meme, there's a ton of stuff that's being invested in as an AI-driven thing, that if you actually get someone that knows what they're doing, looking under the hood, there's no real AI in it.
Mm-hmm.
Remember nano, remember this, that. So same kind of thing is that we can differentiate between what is and is not actual AI, and to what depth and breadth it is capable of, and be there early and take it from there. So
look where the smoke screens are. I think it looks like, Patrick, were you going to say something?
No, I was just agreeing completely. I think it's very fair. I think the only other point that I think is critical to think about is just making sure, like, the way that the product is, right? Like, I think it was mentioned earlier that there needs to be some traction. The way that where the product is and where it sits and what market it sits in is really going to constitute whether or not it really looks attractive. Like I think a lot about these fulfillment centers, right? And AI and fulfillment centers. And like, there's lots of different pockets like that make a lot of sense. And then, you talk about a pizza delivery service that's, AI driven, and that's going to take your pizza in and, to deliver to you, right? That SoftBank invested in and lost $375 million on. So there's two sides to that for sure. And I think just making sure you're in the right market and being in the right place is incredibly important there.
yeah, our founder was approached by a guy who had an AI-driven coffee cup that would measure like the sip rate versus the temperature. And
You got to address a problem. Yeah, you're absolutely right, Joe. Like if it's not a problem that's actually there, right? If you're trying to fix a problem that doesn't exist, what are we talking about? It doesn't really make a whole ton of sense. So.
Yeah, that's not limited to AI though. Unfortunately, engineers, when they're left to run loose, will do that in any domain. To bring it home, Christine, back to the security question, I serve as the UT Ethics Project Industry Fellow, and the reason I'm doing that is that I think our industry here means both software and hardware, is now mature enough, big enough, impactful enough, and invasive enough that it's time for us to start paying attention to the soft issues like ethics. And there's no more obvious place where ethics matters than when you come into AI. And so one of the things that we're having a hard look at is how do we integrate best practices around ethical development of software and products in the technology arena that integrate AI, because that's a little bit like the sorcerer's apprentice, that magic wand that if you're not careful you can really hurt somebody. And we're seeing it, now in areas where bias in hiring and loan making and all kinds of different areas are unexpectedly and certainly unintentionally causing some damage to people. So we're getting lots of good early examples of why that question you asked matters so much. And I think, one of the things that I've been hearing anecdotally through Nick and others that are based in Europe is that we got a supreme challenge on our hands of, on a countrywide or a continent-wide basis, how do we set standards like the first early efforts that the European Commission has made, and like our own efforts here in the United States to sort of dictate the rules of the road by which software data can be manipulated, managed, owned, and used. And I think this is our first try, but it's not going to be the last try, because the first try isn't the right try. But I think in the short term, your concerns from the healthcare space are the early examples of areas where rules have been put into place, and if you get it wrong, the penalties are kind of harsh. And so, I'll take GDPR as an example. I mean, it's eye-opening when you think about it, that if you, as a software company, are found to have violated those rules in Europe, it's a stiff fine, and it's either X% of your revenues or 20 million euros. Which if you're a startup, you're done if you get it wrong. So, I think we're learning is how I would say it. But
has anybody got into GDPR yet?
Not that I've heard of.
We'll see what actually happens.
Right. So I think, to kind of bring that home and back to I think the best defense in that arena is to do your very best to figure out how you would want your data handled if it was you. And try and build your software product accordingly.
Is there a commission or anything that kind of helps body this? I mean, in healthcare, we have all kinds of JCOs and all kinds of stuff. There's got to be some sort of commission helping protocolize things, no?
Not so much as you might think. It's early days, but that there's a role for some of the standards bodies like IEEE and ACM. And they do have ethics committees set up that they're trying to start figuring this out, but it's a huge problem.
So can we segue into like where everybody's deal flow is coming from, and how they look at deals and find deals, and where they think there's rich places to look that they can disclose, and then also what's the impact on venture of COVID? Have things slowed down? Have they sped up? Winners and losers. I think we discussed it a little bit, but maybe some more. So, Johnny, why don't you talk about where your deal flow comes from?
Yeah, I think, it's interesting. A lot of people talk about the proprietary network, right? Which is really just friends and, relationships that you've built throughout your entire career, and not discounting that, because the reality is that does matter. And that is probably for us our #1 source of deal flow. But I mean,
Johnny, I'm just wondering, how many roommates do you have in a Stanford dorm?
I know, right? It's way too many. Hundreds. And they've all started unicorn companies, and yeah, I decided to become a musician. But in all seriousness, a lot of what we've been thinking about, again, we come from this perspective of data, and how we can leverage data as a way to inform investment decisions, but not just how do we use it as a way to inform investment, but also as a way to inform other activities of our business that are fundamentals of the business. And so from a deal flow perspective, a lot of what we think about is what is the data that's out there that we can scrape, that we can collect, that we can analyze, that we can have our engineers build machine learning algorithms on, and pattern match, et cetera. A lot of what we've been thinking about is, if we are trying to truly build a data-driven fund from the ground up, how do we think less like a typical venture fund, less like a typical hedge fund, and more like a technology company. How do we bring quantitative, or what we like to call quantamental, quant plus fundamental investing from the public equities world to the venture world? And so for us, a lot of what we're focusing on in our hiring and roadmap and things like that is building a team that allows us to building a team of engineers that will allow us over time to analyze and track different companies at different stages. We're opportunistic investors, right? We're a single LP family office, but our managing partner and founder just happens to have built a company specifically focused on building out tools for professional hedge fund managers and investment managers. And so how do we use some of those resources internally to help inform things, not just how we want to invest, but how we want to source deals too. And so obviously, without giving too much away, we think a lot about looking at different company data points and metrics, looking at different sources of companies at the earliest stages, from accelerator programs to universities to Y Combinator, et cetera. And then, once we have that pool, doing the secret sauces and doing the meta-analysis on those different data sets and correlating different data sets to see, okay, for a class of company in X space, these Y data points are most, are the strongest correlation points for whether they're going to raise the next round of financing. So, that helps us think through, okay, do we want to preempt the Series A? Or if it's a later stage company in which there are a lot more data points, oftentimes, when we approach different companies, they'll share, different data points with us. We can then use that to match against public comps. And so this is sort of how, having both the public and the private side is, very helpful. We're looking at public comps all day to help inform companies at the very late end of the spectrum, to help also inform companies we want to, actively go outbound and reach out to, right? Like if we see the public markets ripping for things like Zoom, what are all the companies in the late stages that are not Zoom, but are in that space that we think have potential secondary opportunities or late stage growth opportunities? And then similarly, go all the way to the earlier stage, just on a macro level, what data points can we see in the market to make us think that there's a huge growth opportunity for a class of companies in X space or Y space? And then, then we'll do the outbound reach out to target certain companies that sort of fall under those different investment theses.
Gotcha.
Hey, Marty, we have a question on the webinar chat, but since your question was so relevant, I think we'll just go around and then come back to the question on the chat.
Yeah, sure. I'd like Peter. Maybe you can answer the same question about deal flow and at what stage you're looking, and
Sure.
Are you looking? Is management more important than the idea? Et cetera.
Great questions. Your kind of question to Johnny about how many roommates does he have. I read today, Stanford class of 2020 started an investment club just for members of the class of 2020, and 40% of the class invested in it. So it's students investing in each other, and it's so Stanford is obviously maybe the best, the most fertile ground for entrepreneurship in the world, I would say. Virtually every company we invest in comes from an entrepreneur we know that introduces us to another entrepreneur. And I've been doing venture for 17 years, and those are always the best deals. It's so there's we are doing we do thematic research in certain areas, but eventually we usually get to someone that we want to invest in because we get introduced by someone we really trust that trusts us. And our whole firm, Amity means friendships and relationships of trust. So we think of the entrepreneurs, that relationship is a lifelong relationship, because we might back that entrepreneur multiple times, or they might be someone that introduces us to another entrepreneur. So we also spend time with the angel community, which is very robust in places like San Francisco, New York, Boston. And that's a great source of I guess, opportunities. And then we spend a lot of time with the big tech companies. So, we'll track people who work at companies like a Google or a Dell, and we'll back them. So we have a company called Cumulo, which just announced a big financing through BlackRock last week. But those were 9 engineers I knew from their previous company. They're in Seattle. And when they decided to spin out, we put the first capital in. That was 8 years ago. And we're on the board and helped them really build the company. So deal flow comes from a lot of areas. There are, as Johnny mentioned, much more systematic tools that some of it's proprietary that people are building to sort of track companies. So we've got a database. We track about 10,000 companies. We source a lot through the AngelList data, where we find out when companies got their initial capital, look at their traction to date, and then go back to our network to get the kind of warm intro into the entrepreneur. I'd say the shift has been very significant. Where when I was starting a company, really back in 97, 98, I think really the venture capitalists had really the power. They had the money, they had the know-how. I think that's dramatically different today. I think there's capital because so much of capital has come into the system through pension plans, through family offices, through sovereign wealth, etc., university endowments. So capital is no longer really, it's really a commodity, so the entrepreneur really has the power. And if I kind of look out, I mean, while it's a very tough time in our world and our society for so many reasons, with social injustice and the pandemic, I would say though that whether you're an entrepreneur or a venture capitalist, there's never been a more exciting time. I mean, it's just amazing. I mean, virtually every industry, I mean, even things, I mean, that were so old school are being uprooted by software, by machine learning, by artificial intelligence. So it's a really exciting time. But I think going back to the Stanford comment, I think if you look at places like Stanford, Harvard, Caltech, University of Washington, University of Michigan, University of Illinois, it's really schools with the best computer science departments. Is where we spend a lot of time with those relationships with the students, with the faculty, and that continues to be, kind of the key to our sourcing.
That's great. Anyone else want to add on to that?
Well, we are brand new. We are actually at the beginning of our capital raise. We're raising $35 million with an initial $5 million tranche. Because we're going to be very selective. We're only going to be taking on board 6 companies a year. We started out with 3 companies that Nick and his team had developed on their own, and with my suggestion, went ahead and threw them into the ventures portfolio so that there was sort of something in the bag as we approached investors. One of those companies is a ed tech, and initially focused on the corporate L&D world. And as you can imagine, that has had just massive disruption with everybody staying home. So they're between the sort of onboarding of new hires, company procedures, regulatory requirements, and actual sort of company product and practices knowledge. There's just a ton of stuff that everyone's required to know. And their traditional model of come on in, sit down, somebody's going to stand at the front and tell you all this stuff is gone. So we have an engine that can basically, you can just sort of pour any text, video, any body of knowledge into it. It can essentially immediately assimilate it, but through a knowledge graph, it actually is understanding and contextualizing it. And then you can just talk to it in natural language and ask it questions, tell it, like, say, what do I need to know about human resources? And it will start answering, you need to go through this and this and this, and then walk you through the steps and be able to engage that you've actually learned it. So we in our early conversations with potential data partners, every single one has leaned in very heavily saying, that's exactly what we need, tell us more. As far as the sourcing is concerned, Nick being long-term in AI, knows, hundreds of some of the key people that are in the best academic programs around the world, folks that he's worked with in the past, that he can go to and has and say, let me know you have 20 people in your PhD program, who's really got the goods? Who would you point to is your real shining star? And we can get answers. And so we have a very good intelligence network to point us toward very, very, very clever people that ought to be looked at and talked to early.
One of the other things we're doing that might be replicable in other environments is I'm currently mentoring about a half a dozen very early stage startups here in Austin. Some of them are affiliated with the University of Texas and some of them are just out in the Austin community, and at least 2 of them are doing some things that look remarkably like deep tech AI. And so, without meaning to, we may be onboarding companies in that fashion. So it's a very patient process because I spend months, and as anybody does, mentoring these startups at these stages. And so that's another way that we're kind of road testing various ways to get deal flow that like I think it was Peter just said, you find the best deals with people who you know and then the people that they know. But that triggers a question for me, which I'll hold until Marty says it's okay.
Oh,
Yeah,
we got about 5 minutes to go.
Right, Marty? What's our time, Marty? About 5 more minutes?
Yes,
Okay, before we go to the last question, Pat, I felt like you didn't get to say anything on this one.
Yeah, no, I mean, it's a little bit different for us, right? We have a very different, because we're late stage, we have the opportunity to be able to talk with really smart VCs that are in front of us, right? So everybody who's early stage, like we get to go and talk to them and make sure that it's a good follow-on opportunity for a lot of these different things. And so outside of our personal network and outside of those, because, Johnny's absolutely right, like personal networks are a big part of this. We're afforded and we're lucky enough to be able to talk to people who are smarter than me in the early stage VC world, and make sure it's a capital efficient business that is addressing all these issues. And just to go off the industry themes just quickly, the things that we really like right now: vertical SaaS, outsourced security, consumer products that are reshaping supply chains, and then IT infrastructure are really the main things that I'm looking into, at least, and that our firm is looking into right now. So
I think IT is critical for everyone. I know for healthcare, it's like totally with the hospitals and everything that's happening right now, total revamp, because people are working from home, trying to run hospitals, and IT is critical. So thank you. I think there was one question from the audience, and I think that'll be a wrap, is Robert Colorodia. How are you prepping your growth portfolio stars like Zoom towards normalized operation post-COVID recovery? Peter's jumping back on. He had a little power surge, so he may jump on. But anyone else want to take that?
Yeah, I mean, I'd say that it's a really tough time to be starting a business regardless of anything, right? Like thinking about if you're growing, I love to do this sort of like quick math of if you're growing at 100% rate, right, which is any really good VC is, and you find yourself, you probably lose, like, so if you're 10 people, right, and at a firm, and you find yourself losing 2, right, just out of pure like turnover, you have to add 12 more people the following year, right? Like that's, if you're growing at 100% to be able to do the capabilities that you're talking about and work at the capacity you want to work at. So to then now be talking to them about how to address this, the COVID and working remotely, and they're making sure their team is being able to work remotely and do it in an efficient way is incredibly hard. I think the way that the constant communication for us is, and transparency is really important. And then making sure, I think it was Joe or Johnny were talking about making sure that the people that you're in contact with and other entrepreneurs, making sure that you're setting them up for success and a good exit strategy. And capital then is really important. So anyways, I could pass it on to somebody else here.
Yeah, Pat makes a really good point there. And I think a lot of the way there's a couple things here. One is how do we help the companies themselves? And then also how do we think about our portfolio internally, when we see, different bets that we've made, potentially peaking, if you will, from that COVID bump. So in terms of helping out companies, our philosophy is the entrepreneurs know their business best. Where we can provide, our service is in our vantage point as investors and looking at things on a macro level. And so for a lot of our companies, what we try to do is produce different trend reports, things like that we've already have, on the Sentio blog, for example, but for private market stuff. And so, for portfolio companies, for example, we just invested in a consumer packaged good. We'll share different industry reports on grocery trends, consumer reports, things like that. Because, post-COVID, all these companies are spiking during COVID, or rather, companies that benefit best from COVID are going to spike from COVID. So what does the world look like after that for them? I think in terms of how we think about internal portfolio construction, it really is a fundamental question as to whether that COVID bump, or rather that the bump that we see from COVID, is going to accelerate or decline based on whether we think what's fundamental about the business is here to stay based on the new trends, right? So again, earlier I was talking about perceived versus actualized friction. So we have this thesis that things like online grocery shopping, as soon as you remove that activation energy, that cognitive load to get because people are literally forced to use an app, they will see the benefits. So we think that category as a whole is going to explode. So what are the second and third order effects of that? And then where should we place bets in those second and third order pockets? And then if we don't think that's the case, on the public side, we are very fortunate that we can just sell our positions. We've already, bought and sold Zoom many times on the rise and the dip. On the private side, because we're typically locked in with these companies for a long period of time. And one of the things that we are structurally fundamentally different with versus a venture firm is because we are a single family office that, structurally, we can invest on our own timeline, right? We're not beholden to a set of external LPs necessarily, which means we can be patient. And one of the things that we try to, tell all the entrepreneurs we work with is structurally, we are the best aligned with, what they're going to do. And so we can be patient capital for the entrepreneur. So all of this is to say, whereas with public portfolio companies, we're able to exit our positions quickly. When we invest in a private company, we are not looking to sell our shares on the secondary market, et cetera. We are making a bet fundamentally on a macro market trend, a human trend, and on the founder's ability, to be, highly impactful people pushing culture forward and improving society.
So guys, so we've got about 30 seconds for each one of you left. Can you each one talk about what you think is the best place to be in VC right now that's not where you are? Peter, what's the best place to be that's not where you are?
Well, I think that the best place to be right now is investing early. I think valuations have gotten very frothy. So I think going back, I dovetail what Johnny just said, you need to have a long-term view. And I think you need to be early. But it's just to give you a quick stat, when companies in my era, like EMC, Microsoft, were going public, only about 4 or 5% of the value was captured, by the private markets. Most of the value creation was happening in the public markets. It's the opposite today. If you look at the first $10 billion of value creation, about 90% goes to the private markets. So
it's remarkable. Yeah. Pat, best place to be that's not where you are.
Yeah. I mean, I think, I talked about it earlier, really the 4 markets that I think are great places to be. But I think, to Peter's point, early stage is a great opportunity. It's just a matter of making sure that, the returns are there rather than, and making sure there's a good exit strategy and liquidation event. So, I think I'll just go with the 4 that I talked about earlier, in terms of
Johnny.
We're sector agnostic, so we do early and late stage. But if outside of venture, I would play in distressed private equity. I think there's going to be, especially in tech. I think the problem with a lot of macroeconomic issues is funding markets might dry up for a lot of late stage companies that don't have the venture growth that VCs are looking for, but that doesn't mean they're not good businesses to potentially buy out.
In many ways, they're great businesses. Joe?
Well, in our case, it would be great to be sitting on a big old stack of cash to invest. But sort of the same thesis, I think valuations have come down a lot. We play at the very early stage. So in our case, it's going to be seeing who survives this episode to be around to invest in when it's all said and done, because there's a lot of people through whatever reason are falling by the wayside. There's good luck and bad luck to be had.
Perfect. Becky?
Genetics.
Becky likes genetics. Fantastic. Well, listen, guys, thank you so much.